Thanks again for stopping by this week, talking about fixed, talking about variable rate mortgages, talking about what you should be considering if you're approaching mortgage renewal. You're looking at your options. There's a lot of conversations happening right now with all this uncertainty in the market, tariffs and the Bank of Canada, unemployment ticking up here in Canada. I mean, what are we to do? What are Canadians to do when making that decision? A lot of questions right now for clients that we're working with that actually have a fixed rate mortgage. Maybe they're thinking about going into a variable, maybe variable clients thinking about going into a fixed, especially as all this conversation on rates potentially coming down and deadlines. I mean, this is literally the question. When is that mortgage coming up for renewal? How much time do you have to shop it? And, making that decision so that you can actually close that mortgage and set it and maybe try to forget it, at least for the next little while. That is really a lot to unpack. And this week, I want to take an opportunity to really disclose a lot of the things that you should be paying attention to when it comes to variable and fixed rate mortgages. So we'll unpack that this week. Once again, welcome back to the channel. If you have not yet subscribed, we invite you to subscribe to the channel. And don't forget to hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace, especially with the Bank of Canada, tariffs, all these conversations that are really important to Canadians that have a mortgage, that are looking to renew their mortgage, even Canadians and young buyers that are looking to go out there and buy and just trying to get a better understanding of the mortgage landscape. So speaking of the mortgage landscape, next week, we have a pivotal announcement from the Bank of Canada that could move the needle for Canadians with a variable rate mortgage. So if you have variable rate mortgage, you may have noticed that every time the Bank of Canada has cut over the last little while, that maybe one of two things have happened, right? Either your payments on your mortgage have come down, they basically got a lot lower, or you've seen your amortization decrease and your payments may have remained the same, but a lot more of your money on that statement, your payments would have actually gone towards principal than towards interest. Now, in both scenarios, both types of variable rate mortgages, whether they be your static trigger rate mortgage, those ones that we've talked about extensively in the channel over the last few years, those are the ones that we saw the amortization scale up really fast, where the payments did not move, versus the ones that the payments did move, right? So there's two different types of variables that you have to be, accustomed to. One is what we call a true adjustable rate mortgage, and then the other being your typical variable rate mortgage. For the most part, if you have one of these two mortgages, you have to understand the differences. And that's point number one. I think it's really, really important because for a lot of Canadians, and we've talked about on the channel before, I don't want to sound like a broken record here, but when we get a phone call about a variable rate mortgage, the first thing you need to think about is, well, what is it that you're looking for in your variable? What's the most important things? Like, what's the checklist? Is it make my payments lower, pay my mortgage down faster, have a little bit more cash flow? What are the options, right? Because with a variable rate mortgage, it's important to understand that if you're selecting a variable rate mortgage, with most lenders, right, it is based on prime. The prime lending rate as of filming this video is 4.95%. If the Bank of Canada cuts a 1/4% or 0.5%, well, obviously that translates to the bank's prime rate, which would either reduce your payments or reduce the amount of interest and increase the amount of principal that is being applied to the mortgage. But you also have to understand that if interest rates on a variable rate mortgage, right, do move, they do fluctuate. Some lenders out there may allow you to re-amortize your mortgage back up to take advantage of those smaller payments. Some may say, no, you can't do that. So you have to understand where your limitations are with your variable rate mortgage. And the best thing to find out, or if you have questions about it, is to obviously reach out to your lender directly and get it directly from the horse's mouth, or reach out to a mortgage professional who has a little bit more insight on different products and different options that can help walk you through the options. Now, speaking of options when it comes to variable rate mortgages, obviously selecting a variable rate mortgage means you have more flexibility. Well, yes, of course you do, because as your payments can adjust, it can move up and down or stay the same, you have the ability to lock into a fixed rate component at the time when you feel that, hey, maybe variable rate is a little bit too risky now. Maybe you think the Bank of Canada is done cutting. Maybe this is today, maybe it's in the future. you can always lock in a fixed rate mortgage. Now, it's important to understand that you can't just lock in. Let's say you want to lock in for 1 year and you're in 5 year term and you're only in your fourth year, for example. Some lenders are not going to allow you to lock into a 1 year term or a 2 or 3 year. You have to correspond to the actual remaining term of that mortgage. So if you took a 5 year, you're in 1 year, technically you'd have to lock in for 4 years, right? Or you'd have to renegotiate or sign back up for a extension up to 5 years. A lot of different ways to play this out. Ultimately, looking at those options, understanding the spreads, the delta between these rates. I mean, what are you getting offered right now for a fixed rate mortgage versus what you're being offered on a variable? And the super important thing, I mean, someone who comes from a bank, a lot of times, a lot of people online may say, yeah, you can do this, you can do that, right? And right now, with a lot of lack of origination of new mortgages, right? Because let's call a spade a spade. There's not a lot of people out there buying. There's still some movement. We have a lot of clients that are going out there with pre-approvals. A lot of them are approved to purchase. Nowhere close to it was over the years, yesteryears, right? Obviously, it's slowed down. So banks have realized this, and some of them are trying to negotiate. Some of them are trying to be a little bit more aggressive when it comes to those mortgages. So you might be with a bank and call them and say, hey, I want to lock in, and they might shoot you a rate because they know they have you sort of confined to their product. And you're like, well, I heard that I can get, or online I see this XYZ. Why is it that you're not giving it to me? Because they know that if you had to leave that particular lender, well, you'd have to pay a penalty, right? So they sort of have you, handcuffed to that particular mortgage. So that's part of it. But important thing to understand with a variable rate mortgage is with most of the major banks and a lot of the broker friendly banks, and there are some nuances within the differences in those particular lenders, and we can get into that in just a minute, but most of them are 3 month penalty, right? You're going to pay 3 months interest on the mortgage, not on the payment, not on what you're paying per month, but on what that interest component is. If you find out what your interest is on that mortgage, add that, 3 months, that's your penalty to get out of the mortgage. The cheaper the interest rate, the cheaper the penalty, the less the term, the cheaper the penalty, right? I mean, at the end of the day, if you're in 5 years or you're in 4 years of a 5 year variable, for example, and you want to break, it doesn't matter that you have 4 years or 3 years left. It's 3 months interest. Obviously, the interest, the longer you have to maturity where that mortgage renews, well, the penalty, the interest is going to be a little bit more, right? But at the end of the day, we're talking, potentially a way out of that mortgage. Now, it's important to understand some lenders will use what the actual discount rate is. So with a variable rate mortgage, as we talked about earlier, it's prime. So right now, 4.95%. You might see a discount of 50, 75, 1% plus, depending if it's an insured, default insured, high ratio mortgage or not. You'll see that. Some of them will calculate the penalty based on the lower rate. Some of them will just qualify based on the prime lending rate. And, you just have to be very cautious about it. Some lenders, depending on where you go, may have a clause where you can't get out of that variable rate mortgage for 3 years, so on and so forth. So understanding when you're signing that mortgage, who you're signing with, what you're getting out of it. If it's sometimes, I would say if it's too good to be true, there might be some strings attached. Not to say that you're not going to get a good product, but that product has to meet your needs. And ultimately, as you're approaching mortgage renewal, especially if you're a seasoned homeowner, if you've been there for a while, a lot of times clients have paid down their mortgage significantly. They may have kids that are approaching school age or, life-changing age where they need help with maybe a vehicle, maybe they're getting married. A lot of things happen. A lot of times clients will say, Anthony, we've worked really, really hard to pay down that mortgage as fast as we possibly could. And we didn't really think about saving, right? We just said, okay, every dollar we had was added into that mortgage and we prepaid it down. But now all of a sudden you have all this equity in your home and you're knocking on the bank's door saying, hey, I want to help my kid out and I need to get a line of credit or I need to take out some money for my mortgage. And now you're going to go pay interest on the money that you've already paid. So if you're thinking about when your mortgage comes up for renewal, obviously have a conversation. A, I think it's important to have a conversation with a financial planner, and B, maybe just reach out to a mortgage professional and have that conversation. Is it better to prepay your mortgage down or, diversify that into the stock market? Maybe now it's not a good time, or maybe now is a great time to invest in the markets, as we've definitely seen a lot of reduction in, or a lot of these good companies are on sale. Now, once again, this is not financial advice. This is not, hey, go out there and put all your life savings into the stock market. But It's more of along the lines as to really think about what the future has in store. Now, we've talked a little bit about variable rate products. Now, fixed rate mortgages. This is literally the conversation. Fixed rate mortgages are really geared to those who, you know, don't like the uncertainty, right? And especially with all this uncertainty right now, do you take a product that is going to be very influenced by what's happening with the Bank of Canada, the US, with trade wars, deficits? This is super important. An election coming up at the end of the month. What is that policy going to look like? How is that going to change? Because remember, bonds move based on spending. If the government's going to spend more money, these bond traders, they may not like that, right? That may create higher yields, higher costs, right? That may translate because bonds are inverse, they're inversely related. So you have to keep that in mind. But fixed rate mortgages generally are for those who want to have a little bit more peace of mind. And I always say fixed rate mortgages come at an insurance premium, right? You might be paying a little bit less than a variable rate now, depending on the type of product, but you're paying a premium because you're locked in, right? So if you're taking a 3-year or a 5-year, you are locked in. There is a contract for that time frame. If you get out, with most lenders, it's not 3 months interest, right? No matter what they tell you, it's based on interest rate differential, based on your lender's calculations of how that penalty is calculated. It's generally on the rate and the amount of time left over on the size of the mortgage and what the current rates are at the time you're breaking the mortgage. If, for example, a fixed rate mortgage today is 4.25% or 4% or 3.99%, for example, I mean, then the rates end up dropping to, let's say, lower than that. I'm not saying that they're going to go much lower than that, but let's say they go down to 3%, just for the sake of argument. Well, now that penalty gets a little bit larger because you're coming out of a rate that's 3.99 or 4% into a rate that's maybe 3%. And depending on the duration left of that mortgage, you're going to be paying the lender that penalty, or you have to stay with that lender even if they offer you a really shitty rate or they offer you maybe not really a really good rate on that particular mortgage. So, excuse my French there, but I've seen it happen multiple times. Clients are like, hey, if I stay with my lender, they're going to offer me this rate, but you're telling me I can get a better rate elsewhere. And then you have to sort of run that math to say, is it better to pay the penalty, get out of that mortgage and switch, especially with lenders that are potentially offering maybe a cashback right now? And speaking of cashbacks, super, super important. A lot of clients loving the cashback option, especially with debts, lawyer fees, depending if you're not closing with the bank internally, you're not using their services. You want to use a lawyer, you need to use a lawyer depending on the situation of your mortgage. If it's straight switch transfer, or if you're changing title or doing some major things, you may want to use a lawyer. You may need to use a lawyer, right? A lot of different scenarios that require a lawyer to be used, as opposed to using the bank's services, which generally can be a little bit cheaper, a little bit more time consuming, but can be cheaper. You have to understand, that cashback component, there are strings attached to it. If you're taking the cashback component from the lender, read the fine print. Some of them will say, okay, there's no strings attached. Very unlikely. Some will say if you're taking the 3-year, if you don't sign back, then you owe us X amount at the end of the 3 years if you're not signing back for another 3. So be very, very cautious. And once again, these are just some of the things that you should be paying close attention to when you're out there looking for your mortgage. If you're thinking about fixed and variable, you're thinking about the Bank of Canada potentially cutting with, the fact that, hey, unemployment ticked up, Canada lost jobs, a lot of uncertainty in the market. Understanding your homework. Are you an individual that's going to do the research? Are you one of the people that are looking at all the news outlets and trying to watch what's going on with the market because you're looking for your mortgage renewal, because you're interested right now? But once you've done the mortgage, are you going to set it and forget it, changing those algos on the social media platforms? And then what happens if you're taking a variable and things start to move? Are you going to be able to catch it in time? Because generally by the time you catch it, it's super important to understand that fixed rates may move ahead of variable rates. And by the time you lock in, you may have lost on an opportunity. So all those things are super important. Tell me, what would you be doing if your mortgage is coming up for renewal? Let me know in the comment section below. But until next week, thanks again for stopping by, and we'll see you next week.